Hello, everyone, and welcome back to this deep dive. I hope you are locked in, caffeinated, and ready for an intensive session because we are tackling a giant today.
We certainly are. We have been getting hundreds of requests to break down the company that has, it's fundamentally reshaped the global healthcare and wellness landscape.
That's right. Today, we are focusing all our attention on Novo Nordisk, trading as NVO. Its primary identity is simple. It is the undisputed global leader in the GLP-1 therapy space, the company behind the transformative medicines Ozempic and Wegovy.
Right, we're talking about a business that has experienced secular growth so profound, it has, fundamentally altered Denmark's entire national economy.
It's an incredible story. And it's built on a foundation of genuinely effective, life-changing therapeutics. The quality of the underlying business is, well, it's exceptional.
No question.
But here is the central question for us, looking through the lens of a long-term, high-quality investor. Given the sudden, intense competitive heat, particularly from Eli Lilly and their next-generation therapies, has NVO's core pricing power and market share been permanently damaged? Or is the recent significant market pessimism and the subsequent pullback in its valuation an extraordinary and rare buying opportunity for a long-term winner?
That tension. That's it right there. The tension between that clinical competition and their sheer industrial dominance is what we're here to analyze. The durability of that fortress.
That is the massive multi-trillion-dollar question, and understanding that durability is the key to assessing the future cash flow of this enterprise. We're going to tackle it pillar by pillar, focusing intently on the financial implications of every strategic move.
Exactly. And before we get into the heavy lifting, just a quick administrative note for everyone joining us.
That's right. For those who want to act on these investing ideas, especially when we discuss complex global stocks like NVO that trade across multiple exchanges, having a professional-grade platform is key.
It really is.
We use interactive brokers, and we've partnered with them to get you a stock bonus when you sign up and fund your account. It's a necessary platform for professional analysis, giving you the tools you need to manage a truly global portfolio.
So you get a bonus to jumpstart your portfolio, and you support the channel at the same time, which is invaluable to us.
It really is. And that link, of course, is conveniently located for you right down in the description below.
Perfect.
And, of course, if you find value in this kind of in-depth, high-level financial discussion, the best way to let us know, and to ensure you don't miss the next one, is to subscribe and like the video. It truly helps the channel. And if you have any questions or further discussion points, please manifest yourself in the comments section.
Perfect. Now, let's get straight to the core of the matter. We begin with pillar number 1. Analyzing the business model and the competitive fortress that Novo Nordisk has built.
Okay, let's unpack this. We have to start in the engine room, understanding precisely where this company generates its massive revenues and profits, because it is remarkably concentrated.
Overwhelmingly is the word. Recent figures show that over 94% of Novo Nordisk's total revenue is derived from the GLP-1 receptor agonist family.
So this isn't some diversified conglomerate.
Not at all. This is a highly focused one-engine machine.
And we should probably name the key components of that engine. Ozempic, the injectable mainstay for type 2 diabetes.
Right.
Wegovy, which is the higher dose injectable specifically for chronic weight management.
Yep.
And Rybelsus, which is the breakthrough oral version of the drug used currently for diabetes.
So the business model seems simple on the surface.
Yeah.
Discover, patent, manufacture, and sell these life-changing chronic disease drugs. But its long-term durability is just phenomenal.
And it's driven by two massive structural tailwinds that, combined, they ensure decades of relevance.
That's the core thesis. The why this franchise matters so much. The first tailwind is just the increasing global chronic disease burden. The worldwide prevalence of type 2 diabetes and obesity is not slowing down.
Far from it.
You have aging populations globally. You have urbanization, shifting diets, sedentary lifestyles. This combination is creating a patient population that is vast, growing, and frankly underserved.
And that market pool isn't shrinking. It's expanding geometrically, regardless of the economic cycle.
Exactly. And the second factor, which is just as important for stability, is the adherence to the therapy. Once a patient starts an effective medication like a GLP-1, this isn't a short-term treatment.
No, this is for life. Chronic disease management requires long-term, high-compliance treatment.
And that is the financial anchor of the business. For Novo, this high compliance creates what we call the customer-for-life effect.
And that translates directly into highly stable, recurring revenue streams. It gives them enormous visibility into future cash flows.
which is exactly why the market paid such a premium for NVO historically. That stability is golden.
So that brings us directly to the economic moat. If those are the engines, what is the fortress protecting them?
Well, we identify the primary moat as a dual-sided intangible asset. It's the combination of patents protecting the compound semaglutide.
Which gives them the legal monopoly for a time.
For a time, yes. But it's that plus an almost irreplaceable manufacturing and process advantage that acts as a physical barrier to entry.
Okay, let's delve deep into that manufacturing fortress, because this is where the money is made, and this is where NVO's decades of specialized expertise really become a barrier.
Yeah, we are not talking about synthesizing aspirin here. We're talking about large molecule biological drugs.
So what does that mean in practical terms?
It means the complexity, the sheer scale required, and the high-yield processes are just monumental. These drugs require highly specialized capital-intensive facilities. We're talking large-scale aseptic filling and fermentation facilities to produce at the necessary purity and volume.
This isn't just an assembly line.
Not even close. It's high-tech bioprocess engineering perfected over decades. And the scale, I mean, if you're going to treat hundreds of millions of people, you need capacity measured in billions of doses.
Which creates that years-to-catch-up mechanism you mentioned.
Exactly. Even with an incredibly effective competing drug, and we have to acknowledge Eli Lilly's tirzepatide, Mounjaro, and Zepbound is certainly that.
It's a great drug.
It is. But Novo Nordisk's pre-existing specialized production facilities mean competitors are simply multi-years behind in matching the output.
This is so crucial to the investment thesis. It shifts the competitive dynamic from a purely clinical war, who has a marginally better drug,
Right.
to an infrastructure war, who can make enough of a good enough drug to capture the market.
That's it. And we have the data to prove this moat is in action. Novo Nordisk still holds approximately 59% of the global GLP-1 volume market share.
And that dominance is sustained, paradoxically, by the fact that the entire industry just can't keep up with demand.
You've highlighted the paradox perfectly. Their own manufacturing constraints have prevented them from realizing their full revenue potential. But that same constraint also protects their market share. It delays the ability of competitors to truly flood the system.
The market is starved, and NVO is the largest supplier available, even at 59% share.
And while Lilly is ramping up, they face the exact same capital intensity and regulatory hurdles NVO faced 20 years ago. Building one of these multi-billion-dollar facilities takes 3 to 5 years.
If everything goes perfectly.
If everything goes perfectly, and that 3 to 5 years, that's the duration of NVO's current industrial advantage.
But we have to address the trajectory of this moat. It is stable, yes, because of that infrastructure, but it is unequivocally under pressure. This is a critical divergence from NVO's history as a company with a widening moat.
They are in defense mode now, and the pressure is intense. It comes from two angles. First, the clinical pressure. The arrival of these highly effective dual agonist drugs from Lilly.
Let's slow down and explain what that means. Novo's semaglutide hits one receptor, GLP-1 receptor.
Right. Lilly's tirzepatide hits two, the GLP-1 and the GIP receptor. It's attacking two targets at once.
And why does that matter in the real world?
It matters because in clinical trials, that dual mechanism has demonstrated marginally superior weight loss and blood sugar control.
So Lilly has a technically superior product.
For certain segments, yes. This has intensified competition and led to market share losses in some key, high-value U.S. segments.
And the second pressure point is internal on NVO's own R&D pipeline.
Yes, the pace of scientific innovation in this space has just accelerated faster than NVO's own internal pipeline replacements.
Yeah.
We saw this vividly with the disappointing data from CagriSema.
Their next-generation attempt.
Right. And while it was good, the data just didn't show that transformative leap needed to clearly beat Lilly's dual agonist. It shows they're starting to lag in clinical efficacy.
Which forces them into a costly defensive strategy. They have to cut prices in some markets.
And at the same time, dramatically increase spending on their supply chain just to defend their position. That shift from offensive innovation to defensive capacity spending changes the margin profile.
And that's exactly what the market is reacting to with this valuation discount.
Let's take a step back and apply a classic mental model. For decades, Novo Nordisk has been a quintessential Tollbridge company.
A Charlie Munger concept.
Exactly. It means they control a unique, high-demand, high-barrier asset. And because the customer base, these chronic disease sufferers, can't easily switch, NVO can extract an economic toll.
And that toll is those industry-leading margins.
That's the toll. But if you dig a layer deeper, using what we call Scuttlebutt. Looking at customer sentiment, you see this fascinating paradox.
Which is?
The products are genuinely loved for their efficacy. Patient reviews are overwhelmingly positive. I mean, they describe them as life-changing.
Yet the brand, Novo Nordisk, is only tolerated by many, especially in the US.
Right, because of intense friction. The consumer experience is complicated by supply shortages and high out-of-pocket costs.
And their recent decision to lower prices for self-pay patients in the US is a direct recognition of that friction.
It is. They know accessibility is a major hurdle, and that high friction creates an opening for competitors.
What about the internal culture? That's also a qualitative asset.
Historically praised for its strong mission focus, a huge asset for retaining talent. However, there are signs of recent internal pressure. We've seen a CEO replacement directly linked to needing a more aggressive market strategy.
And some workforce reductions. That's a warning sign.
It is. If you don't manage that pressure, you could lose the key R&D talent you need to win the next generation of this war. The people are the moat, too.
Absolutely. And that takes us smoothly into Pillar 2. Let's move from the business model to the people running it and the financial integrity of the balance sheet.
How resilient is this fortress when money is being thrown at it?
That analysis starts with leadership. The news that Lars Fruergaard Jørgensen is stepping down in 2025 created some natural uncertainty.
Well, when the captain changes course midstorm, investors pay extremely close attention. And the new direction, signaled by the incoming CEO, Mike Dowstar, is one of sharper strategy and aggressive execution.
Smart risks is the key phrase I've seen.
That's it. We're talking about an aggressive acquisition and licensing strategy, like their rumored bidding for companies like Metsera. This is specifically to plug those clinical pipeline gaps we identified.
It's a proactive pivot to counter Lilly's lead.
And it's critical. It acknowledges they can't afford to wait for their internal R&D to catch up. They have to buy the future, or they risk being left behind. It's expensive, but strategically sound.
What gives them a major qualitative edge here, though, is the structural alignment from the Novo Nordisk Foundation.
That foundation ownership structure is almost unique in Big Pharma. It mandates a perpetual long-term stability focus.
So management is inherently owner-oriented, not just chasing quarterly earnings.
Exactly. Executive pay is tied to financial targets, but also non-financial ones like sustainability and patient access. It's a huge anchor that ensures they're focused on multi-decade value creation.
Okay, let's look at how they are actually spending their cash. Capital allocation is paramount right now.
And the picture is crystal clear. Heavy deployment of cash focused intensely on reinvestment, R&D, and massive manufacturing capacity expansion.
You have to highlight the massive surge in capital expenditure, or Capex. Recent figures show a staggering 83% increase in the purchase of property, plant, and equipment in 1 year.
That 83% jump tells you two things. First, management's profound conviction in the long-term demand.
And second,
the realization that the primary constraint on their growth today is not demand, but their ability to make the product. They're sacrificing today's reported free cash flow to secure years of future growth.
and this is concentrated in facilities that support the entire GLP-1 family, including future oral versions.
Right, and you contrast this heavy Capex focus with their shareholder return policy. Dividends have been maintained and grown.
A nod to the long-term investors,
Right. But share buyback programs have been paused or dramatically reduced.
which, to us, passes the rationality test. Prioritizing the moat and the pipeline over buybacks is the most rational use of capital in this environment.
Absolutely. They are thinking in 5-year construction cycles, not quarterly earnings reports.
Let's now look at the financial fortress through the lens of key quality ratios.
And the profitability is just exceptional. We're looking at a net profit margin of around 35–36% and an operating margin of close to 46%.
Those margins are practically unheard of at this scale.
They demonstrate the formidable pricing power inherent in the Semaglutide patent Moat. But the single most compelling number that just screams high quality is the return on invested capital, ROIC.
NVO reports an ROIC of approximately 41.42%.
That figure is extraordinarily high. To give you some context, most capital-intensive industries struggle to get an ROIC above 15%.
So for every dollar they've invested back into the business, they're generating over 40 cents in annual return.
That strongly validates the wide moat assessment more than any verbal description ever could. It's just phenomenal capital efficiency.
But let's talk about the nuance of the present. Free cash flow. While solid, around $8.8 billion, The conversion rate is under pressure.
And we know exactly why. It's directly related to that 83% Capex surge. The FCF is temporarily depressed because they're funneling cash into building new facilities.
So it's not declining cash flow due to business weakness.
Not at all. It's declining reported FCF conversion due to necessary, intelligent, and massive investment. We expect this to rebound dramatically once that new capacity comes online.
And the balance sheet remains strong, low debt, manageable.
A robust financial fortress, backed by an attractive EV to EBITDA of around 8.4, calculated against high and growing earnings.
So we have a fundamentally high-quality business, financially sound, that is investing aggressively in its future. The question is, does the valuation reflect that, or is the market being overly emotional?
And that takes us directly to Pillar 3, valuation, risks, and catalysts. Let's start with the valuation dislocation. Historically, the market was happy to pay a huge premium for NVO.
We're talking a 10-year average forward PE of around 24. Quality demanded a premium price.
Contrast that with today. The stock trades at a depressed valuation. We're seeing a forward PE of around 11.67 and that EV to EBITDA of about 8.4.
A massive compression from its historical median of almost 18.
It is.
Now, why the sharp discount? What's the market's reasoning?
It's pricing in maximum fear. Intense competition from Lilly, non-core pipeline setbacks like the Alzheimer's trial failure, and the internal pricing pressures. The market is pricing in sustained growth deceleration and long-term margin erosion.
In short, the valuation multiple today suggests the market thinks Novo Nordisk will, in the long run, lose the GLP-1 war.
Or that pricing power will be completely eradicated. And this just reminds us that price paid is the ultimate determinant of returns. We saw this in late 2024. An investor who bought NVO at its peak valuation
PE over 17.
bought a wonderful company at a terrible price. And that led to a painful, rapid 60% decline.
A great company is not always a great stock.
Exactly. Conversely, the argument today is that buying after that decline means the current price already accounts for a material amount of bad news.
So how do we define a margin of safety for a premium asset like this? It's not a traditional low PE play.
Precisely. The margin of safety here is the likelihood that these temporary setbacks, the CEO change, the Capex surge, do not permanently impair the value of the core GLP-1 franchise.
The safety isn't in the absolute price, but in the enduring quality of the asset.
Right. And what we have right now is maximum market fear of competition. The price implies a total collapse of market share that is, highly unlikely given their manufacturing lead. The gap between that fear and the industrial reality is the margin of safety.
Okay, let's talk about the fuel for the engine. What is the primary growth engine for the next decade?
It comes down to one overwhelming factor: global penetration of the obesity drug market.
This is the single most important driver. GLP-1s are transitioning from niche diabetes treatments to the standard of care for chronic obesity and related cardiovascular risk.
And the scale of this addressable market is just staggering. We're talking about hundreds of millions of people worldwide who could potentially benefit.
It dwarfs the existing diabetes market. It provides decades of runway, even with competition, because the market is just so vast and so underserved.
Right. And to unlock that runway, NVO needs catalysts, and there are two major ones on the near-term horizon.
The first being
The successful launch of the high-dose oral semaglutide for obesity. Approval and launch are expected around early 2026. This is a game-changer for access and convenience.
That convenience factor cannot be overstated. A pill instead of a weekly injection. That unlocks a massive new patient pool.
It removes a key point of friction. It makes treatment accessible at the primary care level, not just the specialist level.
And the second catalyst.
Positive outcomes data on adjacent disease states. Strong, unequivocal data on GLP-1 used for cardiovascular benefits or for other large indications like NASH, MASH, or chronic kidney disease.
We should clarify those. NASH and MASH are fatty liver diseases, huge problems globally.
Right. And if the data shows that GLP-1s definitively benefit these patient groups, it validates the drug's use far beyond simple weight loss. More importantly, it dramatically improves payer coverage.
It makes the drug an essential cost-saving expense for insurance companies, not an optional lifestyle drug.
And that shift in payer perception is the key financial unlock.
But we have to balance this with the risks of permanent impairment. What are the threats that could render the entire franchise obsolete?
The first and most existential risk is a superior third-generation therapy from a competitor, a drug that is significantly more effective, safer, and maybe easier to tolerate.
One that renders semaglutide therapeutically obsolete before its patents expire in the early 2030s.
That's the nuclear option risk. The other major risk is aggressive regulatory or pricing intervention, especially in the U.S., their highest margin market.
Price controls would gut those industry-leading margins.
It would fundamentally alter the investment case.
Okay, let's move into our final synthesis, Pillar 4. Let's summarize the core bull case and then apply our contrarian red team challenge.
Let's synthesize the bull case for owning Novo Nordisk today. I think 4 key points stand out.
First, the irreplaceable franchise. That decades-long IP and manufacturing expertise create a wide moat, preventing a massive, predictable, high-margin cash flow stream.
Second, the secular growth tailwind. You get non-cyclical, multi-decade growth exposure in the chronic obesity and diabetes market. That growth is structural and guaranteed.
Third, financial quality. You have that 35% net margin and an extremely high ROIC of over 41%. They know how to deploy capital effectively.
And fourth, the price dislocation. The current valuation trades at a significant discount to its historical premium, providing a rare margin of safety for a company of this quality.
Now let's turn this on its head. The prevailing market consensus right now is peak Novo Nordisk. The competition is too intense, Lilly has a better product, the best growth days are over.
And we have to challenge that. The contrarian view is that the market is dramatically underestimating the durability of that manufacturing moat and the sheer size of the obesity market.
The market is hyper-focused on the marginal efficacy difference and completely ignoring NVO's multi-year capacity lead in producing a good enough drug at enormous scale.
Our analysis suggests the current market failure for NVO is a supply problem, not an efficacy problem, and that massive 83% Capex investment is the transition point.
Yes, that investment shifts the company from supply-constrained growth to demand fulfillment and market share defense.
Right. And once that new capacity comes online, this could drive earnings growth back into the high teens, surprising a market that is priced in terminal deceleration.
So the temporary low valuation is an opportunity to buy the enduring leader in a secular growth industry at a price that reflects panic, not permanent impairment.
That's the bull case.
But to truly stress test this, let's run the red team challenge. What is the most compelling argument for why buying NVO today could be a major long-term mistake?
This is the creative destruction scenario. The bull case rests entirely on the enduring quality of semaglutide, but if we invert that, Novo Nordisk is a one-product family company in the midst of a technological revolution it catalyzed, but did not accelerate into the next generation.
And the $150 billion plus market they created is now attracting the world's best scientific talent and capital.
This is where innovation accelerates beyond anyone's control. And if a rival, be it Lilly or a smaller biotech, launches a drug with a 1.5x improvement in efficacy.
So approaching 30% weight reduction.
With a cleaner side effect profile, and critically they can scale production quickly, semaglutide could become medically inferior and obsolete extremely fast.
So their whole patent moat and cash flow engine could just enter an irreversible decay phase long before the patents legally expire.
Exactly. The recent stock decline isn't just about Lilly having a slightly better product today. It's the market recognizing the risk that NVO's rate of innovation is lagging its fiercest competitor.
And in pharma, the best drug, not just the one produced at the biggest scale, wins in the long run.
It always does.
So we are left with a fundamental tension. The world's best chronic disease cash flow engine, facing its fiercest competitive challenge at a price that implies significant pain, is already behind us.
It's a classic investment dilemma. And to leave you with a final provocative thought to mull over, if the current low valuation implies the market expects Eli Lilly to eventually capture 80% of the obesity market,
Which is a huge shift.
a monumental shift,
Yeah.
what does the necessary multi-trillion-dollar capex required for Lilly to build the facilities to achieve that scale imply about the longevity and expense of building a competing moat?
That's a fascinating inversion of the thesis. What does the sheer difficulty of building that capacity mean for NVO's current position?
It implies that the hidden difficulty in time required, the very thing Novo Nordisk already possesses, validated by their 31% ROIC, is worth far more than the market is currently assigning to NVO's existing infrastructure.
The capacity barrier is a hidden, massive, enduring asset.
It could be.
A great point to end on. We encourage you to continue this conversation, particularly on that CapEx question, in the comments section below.
Thank you for joining us for this deep dive.
We'll see you next time.